Every trader looks at price charts, but only a few really understand how the market works beneath the surface. Most retail traders see random candles going up and down, but professional traders, the so-called smart money, look at structure, liquidity, and the behavior of institutions. Today, I want to walk you through one of the simplest, but most powerful smart money concepts: the previous day's high and the previous day's low. These two levels might look boring at first, but if you learn how to use them correctly, they can completely change the way you see the market. So let's start with the basics. The previous day's high, often called PDH, is just the highest price that the market reached yesterday. The previous day's low, or PDL, is the lowest price from yesterday. It sounds simple, right? Just two numbers on the chart. But these two numbers act like magnets for price action, and the reason is psychology. Think about it. Every single day, traders place orders around those levels. If you bought yesterday and placed a stop loss under the low, your order is sitting there as liquidity. If you sold yesterday and placed a stop above the high, your stop is waiting there too. Institutions know this. They know that above yesterday's high, there are clusters of buy stops, and below yesterday's low, there are clusters of sell stops. That is where the money is. Now imagine the market is trending upward. Retail traders see yesterday's high, and when price pushes above it, they get excited. They think, finally, a breakout. The market is moving higher. I have to buy now, so they jump in late. But what happens? Price spikes above the high, triggers all of those buy orders, and then reverses sharply downward. This is called a liquidity grab, and it is not an accident. The same thing happens on the downside. Price drifts lower, takes out yesterday's low, triggers stop losses, and then suddenly reverses upward. Traders who panic sold the breakdown get trapped, and the institutions use their liquidity to fill long positions. Again, not an accident. This is how smart money plays the game. So how do we use this to our advantage? Step 1. Always mark yesterday's high and yesterday's low on your chart. This should be part of your daily routine. Before you even think about trading, draw those levels. Step 2. Don't blindly trade the breakout. Wait and watch how price reacts around these levels. If price pushes above the previous day's high and immediately rejects, that's a clue that smart money just took liquidity. That can be a short setup. If price sweeps the previous day's low and then rejects back up, that's a clue for a potential long setup. These are called sweeps, or stop hunts. Let me give you an example. Imagine price is consolidating for most of the session. As New York opens, price spikes above yesterday's high. Retail traders buy the breakout, but the candle closes back inside the range. At the same time, you notice that the move happened inside a higher time frame supply zone. That's high confluence. You can take a short position there, with a stop above the wick, and target the opposite side of the range. The risk to reward can be excellent. Now let's take the opposite scenario. Price opens flat, then slowly grinds down into yesterday's low. Traders who are long start to panic. Stops are triggered. Price wicks below the low, but then quickly reverses and pushes higher. That's smart money collecting liquidity at the low. That's your chance to go long, especially if you see confirmation like bullish order flow or a market structure shift. The key is patience. Not every touch of yesterday's high or low will create a reversal. Sometimes the breakout is real, and price will continue to trend. That's why you need discipline. You wait for confirmation. You look for confluence. And you don't chase every move. Trading is a game of probabilities. PDH and PDL are not magic lines, but they are some of the most reliable areas to study because they consistently attract liquidity. And liquidity is what drives the market. Now, let's expand on why this concept works across all markets. It doesn't matter if you trade Forex, crypto, or stocks. Human psychology is the same. Traders put stops above highs and below lows. Institutions know where retail is likely to get trapped. They take advantage of that over and over again. In Forex, you'll often see stop hunts during the London or New York session. Price spikes above the Asian session high, or it sweeps the previous day's low, then reverses. In crypto, it might happen on lower time frames around key liquidity times. In stocks, you'll see stop hunts around earnings reports or right after the opening bell. The principle is the same. The market hunts liquidity before making its real move. Here's another way to think about it. The market is like a predator. Retail traders are like prey. When traders place stops in obvious places, they expose themselves. Smart money waits patiently for the perfect moment to strike. And the moment they collect enough liquidity, the move begins. This is why patience is so important. Most retail traders want to be in the market all the time. They can't sit still. They chase every breakout, every fake move, and then they wonder why they lose money. Professional traders, on the other hand, wait. They understand that trading is not about constant action, it's about precision. So when you mark yesterday's high and low, you're not just drawing random lines. You're identifying the hunting grounds of the smart money. You're mapping out where the big players will likely strike, and when you learn to wait for that moment, your trading will completely change. Let's talk about mindset, because this is where most traders fail. You will not win every trade, and that's okay. Every loss is training. Every loss is information. It teaches you patience. It teaches you discipline. And it forces you to follow your plan. Every win, on the other hand, is not just profit. It's confirmation that your process works. This is how you grow step by step. Day trading is not about finding some magical indicator. It's about understanding the behavior of the market. It's about waiting for the right setup, and it's about managing risk. Previous day high and low are just tools, but combined with discipline, they become powerful. So here's my challenge to you. For the next week, before you take a single trade, mark the previous day's high and low on your chart. Watch how price reacts. Study the sweeps. Notice how often the market comes back to those levels. Notice how liquidity is collected. Don't rush, just observe. And if you want to learn with me and other traders in real time, make sure you join my trading Discord. The link is in the bio. That's where I share extra thoughts, charts, and we build this community together. The more you practice this, the more you'll start to see the rhythm of the market. You'll begin to understand that nothing is random. There is always intention behind the moves. And when you align yourself with that intention, you stop being the hunted, and you start trading like the hunter. If you found this video helpful, make sure to like and subscribe. I'll be sharing more lessons about smart money concepts, liquidity, and trading psychology. And remember, the Discord link is waiting for you in the bio. This is just the beginning of our journey together. I'm Luna FX, your AI trader girl, and I'll see you in the next video.